So let's talk about 11 price action patterns that you must know. They are my favorite patterns in price action that I have learned in my 14 years of being a trader. And I will show you exactly how to use them, what they mean, how to trade them, and you will see how powerful they are. So let's get into the video. And the first one is maybe my favorite one. It's the triple tap. And I've made a video or two about it before, but let's revisit it. And the triple tap is kind of an exhaustion pattern. And what we see often in an ongoing trend is that as the trend matures, as the trend goes on, the likelihood of a reversal increases. And there are a few signs that help us estimate the likelihood or find those transition points. And a triple tap is one of them. So in an uptrend, usually you will see that the market is making higher highs and higher lows. So for example, here on the left, the market made lower lows, it transitioned to making higher highs. However, as this pattern unfolded and as the trend unfolded, the trend weakened. And we can see here that the last highs here, from this point to this high, yes, there were higher highs, but the highs are very weak, as we would say, because the market was not really able to push higher very significantly or very strongly. It's not a very convincing bullish sequence here. So a triple tap, as the name suggests, is 3 taps, 3 higher highs, but each high shows a little bit more weakness, and that is a sign that if you are in a long trade, it's maybe time to scale out of the trade, maybe completely close it, and start looking for reversals into the opposite direction. And when we talk about price action in general, price may be the king. A lot of people are throwing this term around, but context is the emperor if we want to stay in this metaphor. So price action is good. Price action patterns are very important. They are powerful, but only in the right context they are really tradable. And so yes, it pays off to learn about price action. I have made price action courses. Check the link in the video description below. But the real power is once we start understanding where to look for the context and where to look for those patterns. So what we see here is that the market is an overall downtrend. You can see from the top left to the bottom right, or from here, the market moved lower, and then there was a bullish trending phase, but the market never came close to the previous highs. So we can already see one layer of context in addition to the triple tap is that we are in an overall bearish trending market. So we add a little bit more context to this trade or this trading plan yet, and we are looking for structures. We have a trend line here, and we have a flip zone. Previous resistance turns into support, support, support. And finding those structures, those levels, and being able to apply those tools gives this trading plan a lot more meaning, because now we can really come up with a good trading plan. So we want to trade short into the direction of the ongoing big picture trend. We see that the bullish phase has weakened and it's not as strong anymore. We can very nicely describe this correction phase with a trend line. We have identified here this flip zone. And a trading plan would be that if the market breaks below this or maybe even retests it, we are looking for a shorting opportunity. This could be maybe on this time frame directly, or you could go then to a lower time frame to find an entry on a lower time frame. But the idea is that we want to make sure the market is breaking above below the trend line and breaking below the swing point here. Why? Because at this point it then suggests that the market is making lower lows and lower highs in the microstructure. Also in the macrostructure, when we look here at the big picture trend. If the market goes here and breaks below this level, we have completed the bullish sequence. We are trading back into the downtrending direction, and that is what we look for. And this is what happens afterwards. You can see the market broke below it, confirmed the first lower low. It made a retracement, retested kind of here the trend line, made a lower high, made a second consolidation, and then the trend unfolded. So it's very, very nice to see those triple taps in the big picture context. We know we want to trade short in the bigger picture, and then we can just use and look for other confluence factors to time our trades. The second price action pattern is the so-called tweezer, and tweezer is pretty easy to identify. It is just 2 pin bars close together or just right after each other, and then the 2 wicks represent the tweezer. However, obviously, just because we have a tweezer pattern, it's not enough to jump on a trade. And as I said, price is king, but context is the emperor. So let's look at what we have. The market is in an uptrend, clearly. You have wave 1, 2, 3, 4, 5. This is, according to Elliott wave theory, a mature trend. And basically what you want to see, or what you can estimate, is that the longer a trend goes on, the higher the likelihood for a reversal, because trends don't typically last forever. However, at the same time, we can also look for correction waves. So we don't necessarily need a complete trend reversal based on Elliott wave. It is often enough also to just look for short-term opportunities. And in this case, we are looking for, or starting here at the higher time frame, at the 4-hour, and then we will drop down on the lower time frame. So in this example, what the tweezer is giving us a bearish bias. And as soon as we get the tweezer, we see, okay, the context makes sense to look for some shorting opportunities. Then we drop to a lower time frame, in this case, the 30-minute. And here we look for microstructure. And we can already see, as I've identified here, we have a head and shoulders. Left shoulder, head, the right shoulder. It's one of the most important and high probability reversal signals if it comes in such a context. A head and shoulder can also be a continuation, as I've shown in other videos. And we also have a trend line. And this combination of a trend line and head and shoulder really nicely allows us to define, again, a breakout point and also to come up with a trading plan. So based on the higher time frame, we want to look for a shorting opportunity. We don't necessarily need to have a huge reversal, but it would be already enough to see here a new correction wave start to the downside. Then we could trade it maybe into the previous low, maybe into the previous swing pointing origin here. So that is why trading on the lower time frame makes a lot of sense, because we don't need to find big trends on the higher time frame. So the idea is that if the market breaks below that, we look for a breakout. We could trade the retest at this structure and then write it down on this time frame. And you can see this is exactly what happened after the price action broke the trend line, broke the structure. The trend line was triggered. We had to break off our neckline. And then you can see the trend unfolded back into the previous lows and then a little bit beyond. Next is the fake out. Some people may call it a trap, a fakie, or give it some other names. It doesn't matter. It just matters what it tells us and how it looks. And again, what do we see here? We see a huge downtrend. Wave 1, 2, 3, 4, 5, 6, 7, 8, 9 trend waves to the downside. And then here we have a failed continuation. So first of all, we see that as the trend went on, the trending waves became shorter and shorter. Here you can see only 3 candles, here a few more. But in the beginning, there were quite a lot of bearish candles during those impulse waves. So we can already see that the trend is weakening. The trend waves are getting shorter. Then we see that the market did break into a new low here, but within 3 candles or 2 candles, the market was back in above the low. And this is here a fake out signal. It's a 3 candle reversal, strong bearish candle, doji, strong bullish candle. It's one of the most interesting and most powerful candlesticks that I am coming across, especially when you trade them on a higher and lower time frame context. But in this case, we're just looking for a fake out. So we already have a few layers of context that we know here from this chart. Here we can then identify a breakout point or an area where we would shift from a bearish bias to a bullish bias. Because at this point, going long would be way too aggressive, because all we have is pretty much just the market not continuing. But we haven't really made a higher high yet. So we are still continuing here right now, this lower high structure of the downtrend. And as long as this is in play, we should not be bullish. But as soon as the market breaks this level, previous support turning into resistance, we could get into a bullish bias, because that's the first time then the market is making a higher high as well. And you can see the market traded back into this level here that we identified and was rejected. And that is why we always need to wait for a confirmed breakout. And you really want to make sure that the price is closing above such an area, because as you can see, here is a fake out, and those are very common. But because we have not jumped onto this, the context has improved of this chart, because now we are looking at a potential inverse head and shoulder. Left shoulder, the head, and the right shoulder is just forming. If the market turns around and trades higher, this would confirm a head and shoulders, or an inverse head and shoulders in this case. And we would also get a higher low. This would then further confirm our idea that the downtrend is slowly over, because in a downtrend you typically don't see higher lows, especially after a fake out. This gives us a lot of bullish context, sorry. And you can see the price did turn around. It broke higher with this candle, retested, then the neckline, and then took off. So you can see we have so many confluence factors that we can stack in our favor. A mature downtrend where it makes sense to slowly start looking for bullish opportunities. We have the inverse head and shoulder. We have the fake out here with this 3-candle reversal. We have the higher low. We have the strong breakout here with this momentum candle. We could, at the moment of this candle close, drop to a lower time frame and then also trade such a retest here of the neckline. That's a very common approach that you could also look into. The double bottom is a very common pattern, but let's try and really understand it. So again, we're looking at this in a context of the longer or bigger picture. We can see the market is in a long downtrend. Wave 5 has completed here. And then the market did try to push lower, but there was no breakout. The market immediately within the next candle is back here above the lows. So a very, very weak market that we are looking at. And obviously this is not always the case. A trend can continue to 7, 9, 11 trend waves. But if you see that the context is lining up, this is going to improve your odds of finding better trades significantly. Just looking at how the trend waves form and how long they are will already tell you something else. Whereas previously, wave 1, wave 3, the market was always able to move lower very easily. And the impulsive waves, the bearish waves, were very strong and very long. Here you can see there was just basically one candle in wave 5. So that's one thing that has changed. Another thing that has changed is also here the retracement or the correction wave has suddenly been very, very long. Whereas previously the market moved lower quite quickly, here suddenly there was no more interaction. It's probably a very big accumulation phase going on here. Furthermore, we have not only the double bottom where we have here the lows lining up, but also you have a flip zone here a little bit above that. Previous support is turning into resistance. So we can all put that together. Again, at this point, how you're going to use this information could be, now we're on the 1 hour. You could go, for example, on the 15-minute, on the 5-minute time frame, and there look for trading opportunities long. This would allow you to be very early on in an uptrend on the higher time frame, in this case the 1 hour. And you could very nicely trade this on the lower time frame by getting in a little bit more aggressively. Usually on the lower time frames, you also have a more favorable reward to risk ratio. Your holding time will be shorter, which is generally preferred by amateur traders. And this is the follow-up. You can see the market did break higher and then started the uptrend. And again, start using such a higher to lower time frame approach can really improve your decision making and your trade timing. Next is the famous 1, 2, 3 pattern. Let's dig into that and see what this means. So a 1, 2, 3 pattern is a candle, or a trend reversal rather, not a candle, a trend reversal pattern. And what you will see is that in this downtrend, we made a lower low here at this point. Then the market made a higher low. And the next low after point 1 is a higher low. This is very, very significant because in a downtrend, you will see that the market pushes lower and keeps making lower lows. If you see that the sequence fails, it means that there are not as many sellers in the market anymore and the price was so low that it's interesting for the buyers to step in earlier and earlier. So the 1, 2, 3 pattern is very, very important in getting a bias. And what we then do is we identify where's the last swing high. In this case, it's around point 2. We draw our level around it and then we wait for a breakout point to trade the breakout or the retest. You can see this is what happens afterwards, and those patterns are all best used in a multi-time frame approach. Identify them on whatever time frame you want to look for them. The market is fractal. This means that you will see the double bottom, you will see the fake out, you will see the triple tap, the tweezer on all the different time frames. They can occur on the daily, the weekly, the monthly, the 4 hour, 1 hour, 15-minute. So you can choose whatever higher time frame you would like to trade and then drop to a lower time frame. For example, if you have the 1 hour as your higher time frame, like in this case, you could drop down to the 5-minute, for example. If you trade or like to trade a higher time frame 4 hour, you could then go to the 15-minute or 30-minute. If you want a more passive approach, look for those patterns on the daily or the weekly and then trade them on the 4-hour, 2-hour or 1-hour chart. Really, that's totally up to you, and you can very nicely use them on all the different markets and all the time frames. Flags are among the most successful continuation patterns. Let's try to see how they look. And a flag is a correction wave. So in this case, I added a 50-period EMA. You can add this to any market, Forex, stocks, indices, cryptos, whatever you trade, and it works on all the different time frames. And in a trending market, you will see that the market is trading above the moving average, coming back into it, and then trading away. And if you want to be a trend following trader, looking for continuation setups around the 50-period moving average is a good idea. Because if you want to trade long, the best price to buy is low. So we want to buy at a low price, and we want to make sure that we can time our trade with some context. And in this case, the flag gives us context. So we see the market is trading in this channel here to the downside back into the moving average. And the flag is just more than the channel. You can see that the market here on the last part of the flag was not able to get back into the lows. So already we have some component of the 1, 2, 3 pattern where the market is not able to make a lower low and it is trading around the moving average. So it makes sense to look for a continuation there. We could also add another factor or another criteria. For example, we draw our last swing point in this channel. It is here. You can see we have some area of confluence here. It also coincides with the upper boundary of the channel. And the trading plan would then be we go long if the market breaks above that or retests it, depending on your trading style. Do you like breakouts or pullbacks? There's really no difference. It's just that some traders prefer breakouts and some traders prefer pullbacks. The dynamics are obviously a little bit different between the two strategies, but if you are trading those types of markets or those types of patterns, breakouts and pullbacks can both be used very nicely. And as what happens, you can see the market shot up higher, continued the uptrend, it moved back into the moving average here once again to make another pullback approach. Not always when the market gets to the moving average, you will be able to find a pattern, a flag or whatever. So you have to be really patient to wait for your opportunity. They will come up, but you cannot trade every bounce off the moving average, or you just have to add new patterns or different patterns to your repertoire that you can find other pullbacks as well. When we talk about the Wyckoff principles, we can talk about accumulation and distribution. And in this example, we have a very nice distribution. And a distribution is basically a market phase after an uptrend where the market or the participants are changing the sentiment, where previously, obviously here, there were quite a lot more buyers. Then the market got so high that for the buyers, it made sense to exit, book the profits. And the price was so high that it makes more sense now for the sellers to start selling. So this is what usually goes on in those distribution areas. You will see a lot of back and forth. And we can gain a lot of knowledge or information about the market by just looking at what is going on here. First of all, we are in wave 9, impulsive waves. You can see a very, very long uptrend. So at this point, it doesn't make so much more sense to look for longs anymore. And it can pay off to start looking for shorts. However, just because the market is in wave 9, it doesn't mean that we're going to go short. That is not enough. We need to have confluence and context. So what do we have? We have the market making lower highs. That is very, very important because it shows that what has happened previously, the market was easily able to trade higher, is not now possible anymore. The market is never able to continue beyond this point. And every time the market moves higher, the sellers come in earlier and earlier and earlier and really push down the price. To the downside, we have this nice support level where the sellers are not able to break lower yet. And this is very common during accumulation or distribution phases, is that you have a very nicely tight defined boundary where every time the market moves into the low, the buyers will come up, move it a little bit higher, all the buyers that are still left, which are less and less every time. And then as the market moves higher, each time the sellers are coming earlier and earlier. So our trading plan is very simple. We wait for the breakout out of this structure. So this is the 2-hour time frame. We could then, for example, go as soon as the market breaks out. We could go, for example, to the 15-minute, to the 10-minute chart, and then look for shorting opportunities. But the key in such a market is really that we wait for the market to get out of this distribution or accumulation. You can see what happens afterwards is the breakout, very strong breakout. This is very common to see in accumulation and distributions that have been going on for a long time, is that the final breakout is going to be very, very strong. Why is that so? There's already been a lot of position building and back and forth going on. And at one point, there are just not going to be any more buyers left. So every time market previously pushed into the level, there were still some buyers left. But at this point, then there are no more buyers. And in this case, the market just flushes through it and breaks out. Then you can see the market came back, retests this support now as resistance, and then drops lower. And we even have a second retracement here back into the level. So very, very interesting approach. You can see afterwards when the retest held, the market then really collapsed. We have here kind of a head and shoulder as a continuation pattern. So there are many ways how you can get into it: a breakout, a retest, a second retest, a continuation trade on the head and shoulder breakout. What is an exhaustion pin bar? Let's find out. So we have here a huge higher time frame trend. We're on the 4-hour chart and the market is very, very aggressively moving higher. And then suddenly we have a pin bar. A big mistake that a lot of traders make is that as soon as they see a pin bar, they jump on it and they will reverse it. And you're going to have a lot of problems doing that because pin bars alone are just not strong enough. There are even strategies there nowadays that trade continuations after a pin bar. So traders know that, or professional traders rather know that the amateurs are taking it too simple. And as soon as a pin bar comes up, they will short it. So there are lots of trading strategies who look to fade such pin bars. But in our example, we want to know more. We want to have more context. So let's go to a lower time frame. And what do we find? We find, first of all, a trend line, and we find a head and shoulders neckline. So previous resistance turns into support and support. We also see that the market is starting to make lower highs. Very, very important as well. So again, we are not jumping on the trend or on the pin bar right away, but we want to go to a lower time frame and then time our trade. What do we want to see? Clearly, we want to see a breakout or a pullback into the level here. So we have a breakout, the market is moving lower, and this is typically where a lot of breakout traders will go on and get into the trade. To protect the stop loss, you could either think about putting it all the way above here. If you want to be a little bit more aggressive, put it above the trend line. Still, there are some areas of protection here. The stop loss would be protected by the neckline, also by the trend line and by the recent high. So that is the principle of a stop. And this is what happens afterwards. The market kept unfolding, started unwinding, and you can see here we have lower lows and lower highs as the trend progresses, and everything started here with the breakout of the neckline. So this is how exhaustion pin bars look. The context here is the big picture trend. At one point, such a trend becomes unsustainable. Not always, but sometimes you will then see the reversal. And in trading in general, it's not about finding something that works 100%, but rather finding something that works maybe 50, 60% of the time, and then putting the odds in your favor by letting your winning trades run and cutting your losing trades short so that you can put the reward to risk ratio in your favor. Lower bounce triangle is a very, very interesting pattern. And what does it look like? So the lower bounce triangle is best looked for in a continuation context. We see that the market is in an uptrend, maybe 2 or 3 trend waves in the trend. The market consolidates, has a little bit of a longer consolidation. But what is the difference here compared to, for example, the distribution? Whereas in the distribution, you can see after a trend, the market started to make lower highs. In the lower bounce, you can see we are still making higher lows. So there's a huge difference. Also, how is the market reacting to the upper trend line? It is staying very close to the upper trend line. So whereas previously the market in the distribution always sold off very, very aggressively and very quickly, in the lower bounce, you can see now we are really sticking here to the trend line. And that is a very, very different picture. And the triangle lower bounce is foreshadowing a potential breakout. Obviously, we don't know at this point, so we're not going to jump on it. And you always want to wait for the breakout here. But this already is a good way or a good chart to start paying more attention to. And on the successful breakout, that would then give you a bullish bias. And this is what happens, the breakout, and then the trend unfolded. So use that in a higher to lower time frame context. This is the 1 hour. And once you see the confirmed breakout on the 1 hour, you may drop to a lower time frame and then time the trade there. Finally, we cannot complete a price action pattern video without a head and shoulders, so let's get into it. And a head and shoulders is a reversal, or can be a reversal, and especially when the context is right, that's where head and shoulders become really interesting. So what do we have? We have wave 1, we have wave 3, 5, and wave 7 impulsive waves. So the market is in a mature uptrend. We are trading here at an important level. You can see when we zoom out, you can see here is an area where the market sold off a few times in the past. So that makes sense to then look for a head and shoulders. We can see again, how's the market trading into the resistance or previous resistance. It is able to stay to the level very, very closely. It's not even able to come to the previous high anymore, not even close. So that is a very, very important market tell. In a mature trend, the market is failing to come back to the highs. And not only failing, it is staying very, very far away from the highs and really staying here close to this area. So that makes sense then to look for a breakout. If the breakout succeeds, then look for a bearish opportunity here. Again, higher lower time frame is possible, and this is what happens afterwards. Obviously, this doesn't work 100%, and there are many times where you're going to run into a fake out. But as I keep saying, trading is not about finding something that works 100%, but it's about really letting your winning trades run, and when it doesn't work out, cut the loss, move on, and don't get emotional. I hope you liked this video. If you did, leave a sub, leave a thumbs up, and I will see you in the next video.